Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is David Whitaker, President of Foreside, to discuss the adoptability of semi-transparent ETFs by advisors and issuers. Dave, it's great to have you with us. Welcome to Trade Talks.
Oh, thank you for having me. I really appreciate your time today.
And Dave, semi-transparent ETFs have been approved for a year now. Any thoughts on the adoptability by advisors and issuers, and do you think they're here to stay?
We do. It's certainly too early to make a definitive statement, but there's certainly positive tailwinds. Particularly, it's a new structure. First to launch was in March. We've seen several adopters and several asset managers come in since then. But I think the good news is they're nearing $1 billion, in assets under management. And recent studies have indicated that, there's certainly interest from the professional investors. If you look at last year's Broadridge study, 80% of professional investors have indicated some interest in the semi-transparent ETFs. Although 2/3 have indicated that they're going to wait a year or so to see these products up and running. I think that's a pretty consistent message that we're receiving when we go out and talk to our buy-side clients, either asset manager or wealth managers. In our conversations with, for example, some wirehouses, they want to see more asset manager adoption. I think the good news there is we're seeing that. They want to see more AUM. We're seeing that. And then they want to see tight trading spreads. So I think all those indicators are really forecasting some future growth and continued growth in this space.
Well, Dave, let's talk about Foreside asset manager clients, of which you have over 500. Are you seeing an uptick in ETF launches, or those expanding their product line with the addition of ETFs?
We're seeing both. So we're seeing existing ETF lineups expanding their offering. I think gone are the days where you're a sort of one-trick pony. So we see several of our clients that are looking to expand beyond being just a leveraged ETF provider or an alternative ETF provider and expanding the product set. We're also seeing new launches as well. Now, certainly with COVID, we saw a general pause over the last 6 months in some of those new product launches, but certainly over the last quarter and certainly entering the fourth quarter, we're seeing those launches coming back and coming back rapidly. We're seeing, obviously, there's more structures available. We're seeing traditional asset managers continue to look at active semi-transparent ETFs. And we're seeing and talking to quite a few that are looking to enter that space. What a great structure, right? You have, you can generate alpha in an ETF whilst maintaining some level of semi-transparency with your portfolio holdings. So we expect to see continued existing client lineups expand, new product launches, and we're really excited about that.
How's the new ETF rule impacting the landscape moving forward?
The new ETF rule. It's another tailwind for the growth of ETFs. In the broadest sense, it's speed to market, certainly at a lower cost, and it's leveling the playing field. So, it brings down the same requirements now for both active and passive ETFs. It also removes what was otherwise former inequities in the exemptive application process and with older exemptive applications. I think as we're all familiar, older exemptive applications had certain abilities, broader disclosure, broader requirements in their written applications. What this does is really it removes those inequities, it levels the playing field, and it also streamlines compliance, which we think is also going to translate to likely more ETF examinations going forward from the regulators.
What are the challenges for advisors and firms trying to enter the ETF market?
Well, the sort of biggest one is the heaviest, the heavy concentration. Top 3 have 80% of the assets. Top 10 have over 90% of the assets. But if you look at recent flows, the top 3, the top 10, they're not capturing flows at the same rate of their market share. So we think that's a very positive trend and exhibits the ability for boutiques and smaller asset managers to grow. And we've seen that with our client base. We see quite a few boutiques that have had tremendous asset growth even through the COVID pandemic. And we also think with the barriers to entry being a lot easier, it still requires you to look at what is the best structure for your strategy. As we think of ETFs, we don't think of it as a binary, mutual funds versus an ETF, we think of ETFs as a really natural adjacent wrapper for a really good strategy. So we're always advising our clients that, when you think of a good strategy, think of applying all the appropriate wrappers so that you address and are able to accumulate assets from the broadest client base.
And finally, Dave, what are the lessons learned that someone launching an ETF should be aware of?
Well, first, it's timing and costs. Measure twice, cut once. You're going to get all sorts of timing estimates and cost estimates. Oftentimes, they're really just inclusive of operations and compliance costs. I think that, and certainly we advise our clients to really focus on the marketing and distribution costs associated with that, because those are going to be multiples of what you're spending on the operations and compliance side. We also feel that you should engage the market makers early in the process. You're building a structure, you're building a wrapper. Talk to the primary market, talk to the market makers to make sure you're not building something that isn't going to suit certainly their needs and even the secondary market needs. Evaluate internal expertise. We see this as a major issue that's getting better. First and foremost, particularly if you're a traditional asset manager used to or accustomed to mutual funds, do you have capital market representation? Do you have someone experienced primary market as you come into the ETF landscape? Additionally, if you are a mutual fund asset manager, those skill sets don't necessarily apply to the ETF landscape. We've seen this over the last decade where, folks that come from a heavy mutual fund environment don't have the requisite environment to engage with the capital markets, the traders. Having mutual fund transfer agency background or experience doesn't necessarily translate over to the capital markets side. So certainly revisiting internal expertise. And then finally, certainly we think the most important is distribution. Whether it's buy, build, or partner, you have to have a really concise, cohesive distribution strategy. Build it and they will come will not work. And if you have a strategy that has not been adopted in another wrapper, whether it's a mutual fund or SMA, the ETF solution is not going to be the magic pill. So, really focusing on the distribution strategy and what you think the next 12 to 36 months are going to look like, and be prepared to provide enough capital to get you through the first 3 years while you build a track record in that wrapper.
All right, Dave, appreciate the insight. Thanks for joining us on Trade Talks.
Thank you very much. Appreciate it.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.